Today I want to talk about DeFi and how these returns are actually generated, what's actually the fundamental source of why you get yield on invested capital in decentralized finance. Because it's very, very different actually to centralized finance. In centralized finance, in the traditional world, it's pretty straightforward, right? There's somebody somewhere in the economy that needs capital to expand their business, for example. They borrow the capital, you provide the capital, and so in the end, there's somebody willing to pay for access to capital, and there's somebody that's willing to temporarily forego that access. And so money flows from the person that needs the capital to the money that provides it. And in the end, there is some kind of loop going on. Somebody works hard, makes a profit, and that profit then becomes in part income of the capital provider. Right? So that's the traditional way. Why there is even an interest rate, right? There are people that are willing to pay for access to capital temporarily. Now, that's pretty different to decentralized finance. There are very different ways to generate yield. And there are basically three major concepts. The first one is, again, borrowing and lending. So somebody, for some reason, and we go to this later on, is willing to pay to borrow Bitcoin. So that's the first. Then the second way to generate yield is you provide capital in a liquidity pool. So you provide capital, a service that's required for swapping different tokens. That's the second way. The third way is basically just Ponzi schemes. So when you see in DeFi 100,000% per annum, that's basically a Ponzi scheme, and these returns are projected in the future with the assumption that the Ponzi scheme stays alive, which of course Ponzi schemes have a lifetime, right? They can only grow so far, so those returns usually do not materialize themselves. So these are very different kinds of risk profiles, and the source of all of this is also very different, right? You've got a very legitimate source in traditional finance. Somebody wants to build a product, wants to make a profit, wants to provide utility in the real world. And in order for this utility realization to happen, they need capital. Thus, they're okay to forego some of that profit. With DeFi, for example, for borrowing and lending, that's different, right? Why would somebody borrow a cryptocurrency? Why would they take on a loan denominated in that cryptocurrency? Why would somebody say, okay, I borrow today 1 Bitcoin and I will pay you back 1.1 Bitcoin a year from now? What can you actually do with the Bitcoin? Can you really go in the real world and do something valuable with it? And the answer is most of the time you can't really provide real value. The value you provide when you borrow Bitcoin is usually tied to derivatives. So what happens is centralized exchanges, they have to hedge themselves when they issue derivatives. So a derivative is basically a bet, right? So you go to a centralized exchange and you say, I want to bet on Bitcoin going down with a leverage of 3x. So as in Bitcoin, when Bitcoin goes down 3%, I want to make a profit of 9%. Okay, so that's kind of like what you want to do as a customer. And that's kind of like your request to the centralized exchange. And the centralized exchange then says, okay, we do this. And here's the spread, right? The bid-ask spread. This is kind of like the fees that we take. This is the financing costs we take, etc. These things might be hidden. But yeah, that's basically how they make money, right? They've got like hidden costs behind all of this. And then they still want to hedge themselves against this. So they personally do not really believe in the Bitcoin price going up that much, and they just kind of like want to take the counter position. They just want to make money with the fees. So they don't want to incur losses in case you're right and the Bitcoin price really goes down. So what they do is they are borrowing the Bitcoin. Okay, and so they have then this Bitcoin denominated loan that they then, after the derivative expires, are willing to pay back again for a little bit of a premium, a little bit of a return, but they can afford this because they charge more in fees, in hidden fees to their customers. So that's kind of like what value they provide. What value do they provide? They're not really producing any real product. They produce a product for speculating, right? That's kind of like the use case. You facilitate other people speculating and stuff. So centralized exchanges do this. You personally can do this as well, right? So if you believe in Bitcoin going down and you actually do not want to go to a centralized exchange and get the counterparty risk, you can go to a platform such as Aave, that's AAVE, and you can deposit collateral. So say a stablecoin, you can borrow against the collateral. You can then, once you've borrowed, say your Bitcoin, you can swap the Bitcoin for, again, let's say the stablecoin. You've got now your loan denominated in Bitcoin, and when the Bitcoin price goes down, then you can buy back the Bitcoin in a future point in time, and you can pay off that Bitcoin denominated loan easier, as in the money you don't have to swap back will then be your pure profit, right? So that's the classic way of shorting, and you can do this. You can short on falling prices. You can bet on falling prices without even being involved with any centralized exchange and have any counterparty risk. So that's one source of DeFi income, right? It's facilitating people betting on falling prices. Now, the second way of generating DeFi income, or the source of that income, is liquidity pool providing. So what does it mean? When you go to a decentralized exchange, such as a Uniswap, or you go to a decentralized exchange aggregator, a DEX aggregator, such as 1inch, what happens is there are different pools of capital, so-called liquidity pools. Okay, so a pool of capital, a liquidity pool, is something that on the one side you've got one asset, the other side you've got another asset. So for example, when you want to swap Bitcoin for USDC, okay, so Bitcoin versus one stablecoin, you want to make that swap, you've got, say, USDC, you want to get Bitcoin from this, you will go to this pool of capital, you put in your USDC, you pull out the Bitcoin. Okay, so there's no order book going on, there's no party matching going on. There was simply just a provider of capital that put in Bitcoin and USDC in the first place, and you, as a person that swaps, just takes from one side of the pool and pulls it from the other. And the price of the asset is basically determined by the relationship of how much is on each side of the pool. So since there are so many of those pools, you've got a lot of arbitrage bots that trade across different pools, because one price might be slightly different, one ratio of those two assets might be slightly different on one capital pool versus the other. And so arbitrage bots always monitor this, and they might do swaps across different pools to ensure that across different decentralized exchanges the price is still the same, and they basically make a profit whenever there is some kind of an imbalance. So why would you provide capital to such a pool? The reason is when you swap, right? When you swap your USDC to Bitcoin, the centralized exchange will, the decentralized exchange will always take a fee out of this. That's typically 0.2 to 0.3%. So you don't really get the same amount of capital worth in BTC back. You get 0.3% less back. And parts of that fee revenue is being paid out to the liquidity pool providers. Other parts might be used, for example, to buy back the token, the native token of the decentralized exchange. But yeah, the reason why you provide the capital is to gain return from the swapping activity on the decentralized exchange. So in other words, your income in DeFi, when providing liquidity, is directly tied to trading activity. How much speculation is there? And you're basically having more or less a share. It's not really a share, but you are participating in the business of that decentralized exchange. You get a cut of the profit, so to speak, of the trading activity. That's where the revenue is coming from. So again, Right? With borrowing and lending, you make money because other people bet on falling prices. With liquidity pool providing, you make money because other people speculate that one asset might appreciate versus the other. So you make money through the swapping activity. So in other words, currently during a bear market when there's not a lot of activity, your income from these decentralized exchanges will also go down. There's less trading activity, less trading volume happening, thus the returns are also relatively low. Now, what are the risks there? Of course, again, smart contract risk, but there you've also got direct exposure to the asset class itself, right? When you provide both Bitcoin and a stablecoin, and suddenly either the stablecoin depegs and is at zero, or Bitcoin goes down in price, then you are affected by this as well, right? Because when you provide that capital, you have a share of the liquidity pool, and suddenly half of the liquidity pool isn't worth anything, then you've got a problem. So that's a risk you expose yourself to. You've also got something called impermanent loss, but that's probably a bit beyond this video now. Basically, when the ratio between the two assets in the liquidity pool goes too far apart from one another, rebalancing needs to happen. So there's even more to this. It's a bit more complex, but yeah, that's basically the idea. You've got price risk that you're exposed to as well. Okay, and then the third one, and this is what most people get most excited about, that's Ponzi schemes. And I want to talk a little bit longer about Ponzi schemes because most people lose a lot of money there, and you can play it right if you know what you're doing. But what's important to note here is that when you think about performance in crypto in general, right, there is the general performance that most people can get just by buying Bitcoin. But when you want to gain more performance than that, when you want to outperform, then this outperformance has to come at the cost of somebody else's underperformance, right? Not everybody can outperform by definition. So when you time the market better, when you buy low and sell high, or when you enter in a high yield DeFi project and you pull out more money than you put in, then that money came from somebody else. Okay, so this is very important to realize, because if you don't, then you're just being blinded by the high APYs. When you deposit into Anchor and you get 20% per annum, and there's nobody else in the crypto market that's willing to pay 20% per annum, and there's some kind of instability in the market that will make something implode, and especially with 100% APYs, it's obviously also not going to work forever. And it's also going to work for just a few people, right? So there will be maybe not 100,000% APY, but maybe you can get 500% out of it. So you can like 6x your money. But that means that a lot of other people, so let's say when it's a 5x, that 80% of the rest of the people that joined this scheme lost all their money. And most of the time, it's not that you lose everything, you just lose maybe 50% of your money. So the fraction of people that actually earn or that make money with Ponzi schemes is very, very small. It's the very few ones that entered very early, or that played the game in the right way. So the easiest way and the safest way, especially in this bear market, is to completely stay away from this altogether, because the likelihood of losing your money is super, super high. Now, if you don't want to accept that, which I can also relate to, because there are opportunities, especially during bull markets, then it's important to ask yourself the question, how will this Ponzi scheme break, and where are we, in what stage are we currently at this in this Ponzi scheme? So you want to know, you don't want to look at the APYs or anything like this. You don't want to look at the positive side. You really want to look at the negative side, because only then you can play it right. For example, you want to see what's the fastest I can pull my money out of the system. How can I be faster in pulling the money out? So for example, when you look at these yield projects, right, at Strong, Block, etc., You want to buy the node that returns the quickest, right? Sometimes there are cheaper nodes that take longer until you go break even. Sometimes, and the ones that are more expensive, they return faster. If you are going to invest in a Ponzi scheme, then you have to bite the bullet and buy the expensive one, right? Because only the fast people are going to return. The ones that buy the cheap notes are definitely not going to return, because then all the winners will already be out. That's one thing. Then sometimes you've got the offer to maybe buy another NFT to increase your returns. That NFT might never expire, or it might have some other kind of benefit to it, but maybe the break-even point of it will be further out in the future, and you don't want to buy this, right? You want to buy the thing that returns the quickest. And then, of course, what you also want to find out is how many people have already entered the Ponzi scheme, and at what pace are they currently entering, right? So you have to do some analytics around this. So one way to do this is to go to Dune Analytics, right? That's D-U-N-E, dune.com, and there you can query different smart contracts. If a smart contract isn't yet there, you can edit, you can make a request to edit, and then you can make simple database queries. So you don't have to know any kind of blockchain programming knowledge. You just, quote unquote, just have to know MySQL, and you do SQL queries against their indexed blockchain data. And then you can find out how did the number of holders develop over time, right? How many people have bought into the Ponzi scheme? Is this still accelerating? Is the growth still going steep up? Or was there maybe an initial hype during the launch? It bumped up in new holders and now it's rather slow. If you see the second, right? If you see the initial bump and now the growth is rather slow, then it's probably a bad time to get in, because all the initial people, they now get their returns from all the people that come in. And if this continues to fade out, then the breaking point will be relatively quick. So you want to be early when there's still accelerating growth. So those are the kind of things to look at. And you have to be 100% realistic around these things, right? If you get into these high-risk DeFi projects, there's definitely going to be losers, and it's definitely going to be the vast majority of people. And you have to be 100% okay to write off all the capital that you put in this. And you have to have an edge in this. You have to have enough of an edge even to be in this top maybe 10% or so that make the return. And most people, right, there's this interesting survey. When you ask people, do you regard yourself as an above average driver in the car, right? Then most people will say yes. Like 70% or so of people think they are above average in driving their car, which is obviously not the case. And so there is not enough self-reflection around this, self-awareness around this. And with investing, it's the same, right? Most people that haven't yet fallen, that haven't yet made any losses, they think they're above average. And that's also that even though many people know that 100,000% APY isn't sustainable and is a Ponzi scheme, even though a lot of people know this, still most people think they can beat the system, but most people can't. And so most people get burned. So you really have to be very, very well prepared to be above average, do all the analytics, know the team very well, know the roadmap very well, know exactly how they do marketing, how they can pull off the marketing, and things like that. So that's simply what you have to be aware of. That's how those work. So what's the takeaway from all of this, right? Are returns legit? It depends, right? The DeFi returns are, in my opinion, less legitimate than the ones in the traditional world, because the value they provide is mainly for speculation. You've got the betting on falling prices speculation. You've got the just trading, active trading kind of speculation return. And you've got the return directly coming from others, where they're not even aware that they are source of the return. So it really depends how you see this. I personally, I do make DeFi plays, especially interest arbitrage. So that's a nice thing a little bit about crypto, right? It's still a relatively immature market, meaning there are not a lot of professionals in the crypto space. So when you know enough, when you learn enough around crypto, you can actually generate an alpha. So learning a lot is really getting paid in crypto. That's not necessarily true for like the stock market, right? Where there's already so many professionals in there. If you just spend your 10, 20 hours learning about it, you're unlikely going to beat those professionals. So spending time on learning traditional markets, trying to pick the perfect stock, etc., is unlikely to pay off. That's different for the crypto market. That's way more fragmented and way less professional. So in that way, I very much do like crypto. But on the other hand, we always have to be aware that your return are very likely somebody else's either losses or at least cost, right? Known cost. And you have to make sure to be on the right side of this. Right? When you provide liquidity for a liquidity pool, make sure you're not the person that's always swapping back and forth and that's paying all the fees. When you're in a Ponzi, be sure to be early in there. When you lend out your crypto, make sure that you've got an asset that you lend out that you're willing to hold for the long term, where the person that bets on the falling prices is not going to make money by you losing during that bear market. So it's all kind of like, to a certain degree, zero sum, especially since you've got either token dilution happening with a lot of inflation, or you don't have the inflation, and then it's just directly the asset moving from one hand to another. So in that way, it's zero sum because it's speculation that's fueling all of this. It's not providing a real asset in the real world. And so when you're in that kind of an environment, simply make sure that you're not part of the masses, but that you somehow outsmart the system. That's usually just by learning more, or by being around a group of people that have done the analysis, that can then point you in the right direction to hopefully also still make your own research afterwards. But yeah, that's my thoughts on DeFi. I think it's maybe a bit grim. Most people think, right, there's return, and it's just more return because it's crypto, it's something new, and of course traditional finance is already so mature, it returns less, and now it's just something new, it returns more. But most important is, where does the return come from? And a lot of crypto is zero sum in DeFi, so make sure you're on the right side of that zero sum game. It's kind of like a poker game in the end. There are chips in the middle, and some people take it, some people don't. The more risk on you go with your bet, the more likely you are to lose. The more research you have to make, the more edge you need against the general populace. Meaning the more the time you invest into researching around this gets rewarded. So never buy into something just because you see a YouTuber pushing something, right? I'm gonna make another video on this as well. That's the plan. To actually talk about how life as a crypto YouTuber is. But the incentives are not aligned, to say the least. So don't just follow what other people are promoting on YouTube. You need more of an edge than just watching a YouTube video, for sure. Okay, that's it for this video again. Looking forward to get your feedback. And there's also another video, again, just talking head directly after this video. I will link this somewhere here. So hope to see you in that video as well. So see you again, and bye-bye.